The S&P 500 has been one of the best performing stock market indices of the last century. As a result, funds that track the S&P 500 have become extremely popular. Since they're a hands-off way to invest and anyone can do it, we've heard the following quite a lot over the last few years. You don't need to know anything about investing, just put your money into the S&P 500 and let it grow. But is it really that simple? Is the S&P 500 actually a safe investment? That's what I'll be looking at today as I dive into some of the hidden risks that most people fail to mention when talking about the S&P 500. But first, what is the S&P 500? The S&P 500 is a stock market index that tracks the performance of 500 medium and large companies in the United States. It's market capitalization weighted, meaning the biggest companies like Apple, Microsoft, and Nvidia have the largest influence on the index. It's widely seen as a reflection of the US economy, and over the long run, it has delivered an impressive average annual return of around 10% a year. But just because something has done well historically doesn't mean it's going to do the same in the future. Don't get me wrong, it might. And at the end of this episode, I'll be giving my opinions on what I think about investing in a fund that tracks the S&P 500, which is also known as an index fund, and whether it's something I think is worth doing. But for now, we're going to focus on some of the risks that should be considered before investing in an S&P 500 index fund. One of the biggest risks of investing solely in the S&P 500 is that 100% of the companies in the index are based in the United States. This means you're putting all of your eggs in one basket, the US economy. And don't get me wrong, that is a very impressive basket. And if I had to put all my eggs in one economy's basket, it would be that of the United States. But importantly, I don't have to. And yes, I know that a lot of these companies are global businesses. In fact, you might be surprised by the amount of revenue that companies within the S&P 500 actually generate from outside of the United States. It surprised me, but reports from last year show that 59% of all revenue generated by companies within the S&P 500 came from within the US, and 41% came from outside of the US. So, okay, not as eggs in one basket as it might seem, but the S&P 500 is still heavily reliant on the strength of the US economy. Whilst the collapse of the US economy and stock market seems highly unlikely, it is always possible. For example, back in the late 1980s, Japanese stocks made up nearly 50% of the global stock market. Fast forward to today and it's less than 6%. And in the 1800s, the UK had the most powerful stock market in the world, until the US overtook it in the early 20th century. I'm not saying this is going to happen to the US stock market today. I don't think it will. But if you're investing in the S&P 500, just be aware of this. History tells us that markets do shift over time. And just because one economy is dominating right now, it doesn't mean it will stay that way forever. Another risk to be aware of is that the average return can be misleading. You hear that the S&P 500 has historically returned 10% per year over the past century and probably think, great, I'll take a 10% annual return, but that's not quite how it works, because it is a roller coaster. In fact, I want you to guess how many times the S&P 500 has returned between 8 and 12% in a given single year over the past 30 years. Because it's a number that surprised me. Okay, so I hope you've got that number. I hope you've got your guess in your head. The actual answer is 3 times. Only in 3 of the past 30 years has the S&P 500 returned between 8 and 12% in a given year. So it might have an average annual return of 10%, but its actual yearly returns are way more of a roller coaster, which is absolutely fine if you plan to invest for a decade or more, like I do. But it is not fine if you aren't prepared for it. So if you decide to invest in an S&P 500 index fund, just be aware that despite the fact that it does average 10% a year in the long run, or at least it has historically, it's very unlikely to consistently average 10% per year. Knowing this can make it far easier to cope with any wild fluctuations when they inevitably happen. Also, it's worth noting that these returns are taken before any fees, which can really eat into your returns. I personally use Trading 212 for my stocks and shares ISA. because it has really low fees, which means that I can keep more of the money that I invest. If you want to join Trading 212, you can use the promo code SNSBonus to get free fractional shares worth up to £100 when you join. This is an affiliate code, meaning that we get a small payment which helps support our free content online. Now, looking at the next related risk, the S&P 500 does not always go up. And I'm not just talking about from one year to the next. There have been actual decades where an S&P 500 index fund would have gone nowhere. And you don't need to go digging through the archives to find an example of this. Let's take a look at the first decade of the 21st century. So between the year 2000 and the end of 2009. Over that period, the S&P 500 actually declined by about 10%. With average annual returns of about minus 0.5%. That is an entire decade where if you had invested $1,000 in an S&P 500 index fund at the start of the year 2000, it would go on to be worth roughly $900 by the end of 2009. Now, there are plenty of people who see the stock market as some kind of rigged system that normal people like us can't benefit from. And I would bet that at least some of these opinions are driven by the really poor returns offered by stocks during that decade of their adult lives, plus living through the global financial crisis, which was one of the reasons why stocks did so poorly over that period. Combined with the come down from the dot-com bubble at the end of the 90s, where investors got way too excited about the internet and caused the stock market to get extremely overvalued, and then come crashing down. So whilst the average return of 10% per year would be great for any investor, just be aware that the S&P 500, and any investment really, can go through prolonged periods of offering you absolutely nothing. The next two risks are ones that get quite a bit more time from the financial media, but ironically, I don't actually think they're as important to understand as the ones that I've just mentioned. The next risk is that the S&P 500 is not particularly diversified. Over 30% of the performance of the entire index is driven by 6 massive companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, and Meta. So by investing in the S&P 500, you might think that you're spreading your money across 500 different companies. And you are, but that doesn't mean that, for example, if you invest £500, you're investing £1 in each company. In fact, you'd actually be investing £150 in these big 6 companies alone, and 350 quid in the remaining 494 businesses. If we extend that out to the 10 largest companies in the S&P 500, then they would account for almost 40% of your investment. Don't get me wrong, a lot of these massive companies are really good companies. And it's the quality of these big names that have driven the S&P 500 to new heights in the past decade. But once again, this is just another risk to be aware of. Whilst you are spreading your investments across 500 companies, about half of that money will only be driven by the performance of 10 or 20 businesses. The final risk I'm going to talk about is valuation. Now, a lot of articles have been written in recent years about how overvalued the S&P 500 is, how UK or European stocks look more attractive on a valuation basis, how the S&P 500 needs to fall in value to stop being too expensive. You get the gist. Funnily enough, this is the risk that I am least concerned about. Yes, the S&P 500 does look expensive when you compare it to some of its historical averages in terms of valuation, but I'd argue there's a reason for it. The companies making up the majority of its returns are high quality, fast-growing tech businesses. They're likely to deliver strong profit growth in the future. So of course they're more expensive than some random telecommunications company in the FTSE 100, because they are better businesses with better prospects. A fact that can probably be applied to a lot of the big companies in the S&P 500. I personally think it's hard to talk about valuation when it comes to a fund covering 500 individual stocks as well. It's hard enough to get people to agree on a valuation for individual stocks, let alone a massive collection of them. So this is probably the least risky risk in my view, but again, it is something to consider. So those are 5 risks that I think any investor in an S&P 500 index fund should be aware of. You've probably heard all the good stuff about the S&P 500, so I thought it's only fair to throw in some of the bad. Now, after going through all that, would I invest in the S&P 500? Honestly, yeah, I would. You know, there are risks to literally every single investment. And this wasn't meant to be an episode designed to scare you away from investing in the S&P 500. It's just to shed a bit more light on these risks, so that you'd be prepared for them if you ever have to face them. And if you have been scared away from investing in the S&P 500, then perhaps it wouldn't have been a suitable investment for you anyway. We all have different time horizons, different risk appetites, different breaking points when it comes to the stress that can be caused by portfolios going up and down in value. But I actually would be happy to invest in an S&P 500 index fund, because I do think the US economy is extremely strong. I do think the giant tech companies still have huge future potential. It's funny because I don't actually invest in an S&P 500 index fund. I opt for a global index fund instead. But over 60% of it is made up of US companies. And I do invest in plenty of individual stocks alongside it that are mostly American companies too. Anyway, I hope you found this video interesting and that you now know a little bit more about the potential risks when it comes to investing in the S&P 500, even though it's something I would happily invest in. And if you'd like to follow along with our investing journey, don't forget to subscribe. I think the next couple of videos should be quite fun because it'll be Andrea and then myself talking about what we invested in when we got paid. Thanks for watching, and I'll see you next time.